Good afternoon, everybody, and welcome to our macro webinar today. I'm Patrick Ganley, along with Angus Geddes. Angus, how are you today?
Good morning, Patrick. I'm very well, thank you.
Nice day here in Sydney, and we'd like to welcome all the members to the webcast today. Just to remind you, we are the presenters today, Patrick and Angus. Just need to get through the normal housekeeping items before we start. All the information in today's presentation is in general advice in nature. Before acting on any of the recommendations or information, we strongly encourage you to consult with your financial advisor. Please also note that past performance is no indication of future performance. And again, all the information is on a general advice basis. During the presentation, you'll have the opportunity to answer questions or make comments. We'll endeavor to work through the questions, comments as best we can, given the time that we have today. The orange arrow shows you where you can enter the questions during the presentation. And as always, if you're having issues with your audio and you can't hear the presenter or you're having some technical difficulties, please feel free to call us in the office 1-300-8811-77, and we'll endeavor to try to help you. And again, if you have any problems hearing this, please give us a call in the office. So Fat Profits Market Update. Angus, I thought I'd start by welcoming you back. I know you had a pretty busy week last week and you were off on a conference, so I thought maybe you might just talk to us a little bit about some of the takeaways you got from your conference last week in Singapore.
Yeah, it was certainly it was a busy week because with the time difference of 3 hours in Singapore, I sort of had to get up at 3 to get everything published and get my note out to the members, and then I then had the conference from sort of 8 a.m. and it was back to back presentations, so 6 o'clock at night, kind of feeling like feeling pretty tired, but it was a good conference. A couple of the takeaways, I think one of the ones that really sort of stuck out was this pervasive bearishness towards China and Hong Kong stocks, and it was the flip side of last year when everyone was quite bullish. China had yet to confirm that it was reopening, but it was, I found it to be a marked contrast to what we saw last year. In fact, as a contrarian sort of indicator, you'd almost be sort of saying, well, were a lot of the analysts and strategists getting super bearish at the bottom. So anyway, so that was one takeaway. Another takeaway, and this isn't just sort of limited to Morgan Stanley, it's sort of tied back to a number of the investment banks. They seem to be tied to this idea of US exceptionalism, and cited that as a rationale for US dollar strength, heading into next year. And of course, we've got I've got a different view on the greenback and where it's headed. And so I thought that was interesting. And Mike Wilson spoke. He always speaks quite well. Didn't get too many questions, and obviously, he's been short and caught this year in terms of his strategy outlook. And but nevertheless, he got up and stuck to his bearish view that we're in the midst of an earnings recession that's going to really manifest itself in the next couple of quarters as GDP growth slows down. So those were probably the main takeaways. I listened to Yum China, the CEO of Yum China, and I was pretty impressed with the fireside chat that she had with the analyst. We don't own Yum China at the moment, but and it operates the Kentucky Fried Chicken outlets in China, along with Pizza Hut. But yeah, it was interesting hearing from her and some of the plans they've got for growth, sort of going forward. So yeah, all in all, it was a good conference, but it was certainly a busy week.
Okay, thanks for that. If we look at last night, most of the indices overseas were up. We did see Wall Street back away from their intraday highs yesterday. That's probably expected given we're heading into a very long weekend. Thanksgiving holiday in the States is a big one. A lot of people leave a bit early on the Wednesday and get off to celebrate Thursday, and the markets will probably be pretty quiet on Friday as well. So Angus, do you have any takeaways from the action we saw? And I know we're going to start with the S&P 500 chart that we have up here at the moment, and the rebound rally set to encounter resistance at 4,600.
Yeah, so I think, look, technically, we've had the breakout above 43.50, and the index is extended higher by a couple of hundred points up to sort of 44.50. And I think, it's got that 4,600 level, which was the high set back in July, in sight. And, chances are that the S&P 500 will probably touch that level sometime next week after the public holiday. I do think at a minimum, there's going to be some backing and filling within a range. I think, that 4,600 level is going to prove to be highly resistant. I think there's quite a lot of resistance around that, clustered around that level. And, for the market really to punch through that and keep going, and indeed to challenge the record highs, we really need to get a semblance that that any growth slowdown in the United States is going to be relatively short, i.e., limited to one, maybe 2 quarters, and that earnings will expand again after that. And secondly, that the Fed will be cutting interest rates by the middle of next year. So there's quite a bit priced in. We also need to see the US bond market behave, and we need to see those yields, on the 2 years through to the 10s and even the 30s continue to, trace out a path of, continue to rally and move to the downside in terms of yields. So, there's a few prerequisites. So I think, at a minimum, we've had this Christmas rally. We're not far off December now. My word, the year has certainly flown by. And I think we're now in for some consolidation until we get some answers to those questions.
Okay, I thought this was quite an interesting chart you put up. The S&P 500 equal weight index, basically showing the average stock is still struggling. Can you talk us through this chart?
Yeah. So look, a month ago, following that big sell-off in the US stock market, that went from sort of August into September and October, we've seen a decent rebound. And I guess, if we look at the equal weight index, which is not an index comprised of the S&P 500 companies' market capitalization, it ascribes equal weight. So what this index tells us is that the average company is not doing as well as the top companies in the S&P 500. But nevertheless, the upward dynamic that we've seen in the last 3 weeks is a better performance, and it does point to rising breadth. So I think, as we go into December, if the bull Goldilocks narrative plays out over the next two or 3 quarters, what we're going to see is growth slow but not go negative. The US avoid a recession. We're going to see bond yields behave, and the Fed moving to an easing bias by the middle of next year. Now, if all of those things play out, and earnings growth is looking to accelerate in the second half of next year, then we'd expect to see the equal weight index break out on the top side above 6,200, and the S&P 500 move back to 4,800. Now, I'm not saying that that's my base case, but that's kind of the bull case scenario as the narrative stands today. So, you know, there's a lot of things that need to fall into place, you know, over the next several months.
Okay, and as we look at the US dollar, I know you touched on that at the conference and how a lot of people were bullish on the US dollar staying higher or heading higher. And your view has been quite different on that, where you're starting to believe or have believed for quite a while that the US dollar was going to weaken. And if we see the Fed starting to cut interest rates halfway through next year, that probably, you know, favors us seeing a lower US dollar. And I thought we could look at this chart here at the moment.
Yeah, well, I think you know, since our last webinar, you know, we've seen some material weakness come through in the greenback. It crashed through that 105 support level to hit the next major support level of 103. So I think, you know, as the crow flies today, the US dollar looks actually quite oversold, and you know, potentially due a bit of a rebound. But I think that, you know, 105 now becomes quite a significant resistance level, 104.50 to 105. And, you know, whilst we might see the dollar improve over coming weeks, you know, I think this is going to prove to be transitionary. And, you know, my call is that we're going to see some fairly significant US dollar weakness next year. That's our base case. And, you know, going back to, you know, what we were talking about at the beginning of the webinar, Pat, about some of the key takeaways, you know, it is remarkable how most of the investment banks and brokers seem to be quite bullish on the US dollar. Whereas I think there's some trouble brewing there.
I think it was quite interesting. You made the comment to me the other night that the sentiment that you got last year in the conference was sentiment that didn't pan out. And you spoke to me about how sentiment for a higher US dollar this time was pretty rampant at the conference, but you know, what they were talking about last year didn't materialize. And everybody in the camp of a higher US dollar, and we're maintaining that you think the US dollar is going lower.
Yeah, I mean, there was no one out there bearish on the US dollar apart from Louis Vincent, who gave quite an interesting alternative presentation. Jared Manack, you know, who used to be one of the main economists for Morgan Stanley, you know, he was also pretty bearish. He thinks that the recession in the US is coming and it's just been delayed. So, you know, he gave a bit more of an extreme presentation. But yeah, there's no one really out there that's particularly bearish on the greenback. So it's interesting. And I think, look, near term, the dollar can rally, it can consolidate. It could push, you know, it could push back to 105, 104.50. But I think that's going to prove to be a fairly significant headwind. And, you know, I guess one of the main reasons that I'm sort of bearish on the US dollar is, you know, one, in terms of what's going on in the bond market. Number two, the fact that, you know, the Fed could indeed be cutting rates next year. That's our base case, and quite aggressively. And then three, you know, as other markets around the world begin to make up for you know, such a significant underperformance gap that's opened up with the US, you know, in the past few years. So I think it's going to be a better year for commodity-based economies such as Canada and Australia, and also I think it's going to be a much better year for Asia, which is in stark contrast to the mood and the sentiment at that conference.
So if all that plays out and we do see a weakening US dollar, I know we've spoken quite a bit about this, that would be very good for gold and I mean, you're looking at a breakout as looming here in the gold price.
Yeah, look, I think this weekly chart, I think the technical setup for gold is really bullish. Now, whether the spot price runs to 2050 in the next couple of weeks and has another setback, or whether there's a correction lower if the US dollar continues to rebound, is anyone's guess. There could be some more backing and filling that takes us into the first quarter of next year. It's impossible to say, when gold's going to break out, which is our base case view. But I think I can say, all things being equal, given the higher reactionary, the series of higher reactionary lows, it's been quite consistent. Any pullback in the gold price, I'd expect to be well supported at around that 1900, 1950 level, which would mean another higher reaction low, before a retest of that 2050 level sometime in the first quarter of next year, which I believe will coincide with another leg down in the US dollar. But technically, this is looking it's looking pretty positive. And also, I would also add that there seems to be a bit more interest now in the precious metal equities themselves. A lot of them are actually doing quite well. Still well down on those highs that we saw back in 2020, 2021. And in terms of the Aussie producers, a lot of them have got higher cost bases, but they're generating pretty good free cash flow. So yeah, all in all, I think the technical setup for gold is looking pretty positive.
Okay, I just thought I'd slip a question in. I got a couple members here asking about your view on silver.
Yeah, so silver, they call it high beta gold. I think silver, the setup for the silver market is also pretty constructive, and technically the outlook is positive. I did cover the silver technicals this week, and I think that silver can also break out to the upside. But like gold, it probably needs a weaker dollar as a catalyst to do that. Although the industrial applications for silver, are numerous, and it is in demand as an industrial metal. It's got certain sort of applications within manufacturing and industry, but it is highly correlated to gold. So I think the silver producers also look pretty compelling at these levels. One way of playing the silver miners is SIL, which is a US listed exchange traded fund. The Global X Silver Miners exchange traded fund, which is basically a basket of the largest silver producers in the world. A lot of them are actually listed in the United States. We don't really have too many pure play silver producers in Australia.
So if you're going to be offshore with a silver play, do you have one in mind?
Yeah, I would go for SIL, which is the Global X Silver Miners exchange traded fund, and it's got a code of SIL in the United States.
Okay, so we'll move on to oil. Oil seems to be finding some support. We've also seen a little bit of declining tensions over in the Middle East, but we're not quite sure how long that's going to go. What's the setup here for oil at the moment?
Yeah, so oil's had a decent pullback, sort of coincided today with OPEC deferring their meeting. Apparently a bit of squabbling going on amongst some of the producers. Some of the African producers are not keen on cutting back their production. Saudi Arabia is kind of flexing its muscle. Look, I think this is all a bit of noise. It's culminating in the low point of that pullback. We saw quite a decent upward dynamic off that $72 low. So, you know, technically WTI crude is looking like it will hold, and that this retracement, although it's been quite big, you know, it's around a 60% retracement. You know, it's looking like it will actually hold, and I think, you know, a breakout above 77, 78, $79 could see WTI crude reassert to the top side in the next coming quarters.
Okay, I thought this was a pretty interesting. Foreign holders of U.S. debt. So thought we'd get your comments on this.
So what's really interesting about this chart, and we're just sort of talking really to the macro environment in terms of the US. I think what's really interesting about this graph and what I've been talking to is that you know, we know that, you know, the Fed are probably going to be cutting rates next year for one reason or another. And that means lower interest rates at the short end of the yield curve. But what about the long end? You know, they've still got a lot of issuance. Their cost of servicing their debt has gone through the roof. Their fiscal spending is still very high, which means there's a lot of supply coming. What is interesting about this graph is that the Chinese, which owned about 1.1 to 1.2 trillion of US government bonds, have been selling, as have the Japanese, and they are the largest owners of US Treasury bonds, and they've been unloading. And I think that's quite significant because, you know, if we get lower foreign participation in the US bond market, it means that the domestic buyer is going to have to step up and do the heavy lifting. Otherwise, you know, what we could see is a higher clearing price in terms of the actual, those longer term bond yields. And it was quite interesting because at the conference, you know, this Louis Vincent gave a great presentation, and he sees a dramatic steepening in the US yield curve where 10-year bond yields rise, the short end gets cut because the Fed has to, and the dollar goes down. Whether we'll see that remains to be seen, but this whole trend where countries such as Japan and China are no longer buying, in fact they're selling, is quite significant. And I think you know, it'd be interesting to see, you know, where this goes next year and just who will step into the breach and be the buyers of all this new bond supply that's coming from the US government.
Have a question here. I thought I'd put this in as someone's asked about the conference, and was there any talk about the trajectory of the yen, given the end of negative rates coming in Japan? And what was your view on the US dollar yen?
There was quite a bit of talk about that actually, and I attended a couple of presentations on that, and the view was that the yen would appreciate next year as the Bank of Japan relaxes and removes yield curve control and gets rid of NIRP and lets the monetary policy tighten and normalize, that will put upward pressure on the Japanese yen. Jonathan Garner, he's quite a good strategist for Asia, who I've got a bit of time for. He's really advocating keeping away from the Japanese exporters and focusing, although they really like Japan, and they've upgraded Japan as an investment destination. This year, we've been there a while, Pat, as you know. John, you know, they're sort of favouring the domestic producers over the exporters, domestic exposures over the exporters. We've mainly got exposure to the financials, you know, which have done really well this year, and I think they'll continue to do well next year. Although I have to say it is becoming a bit of a crowded trade. The last point I'll make about the yen, though, is, and I wrote a little bit about this earlier this month. There's a very large hedge fund in the UK that has an enormous bullish bet on the Japanese yen, and they see a disorderly unraveling coming in FX markets where the yen rises way more than probably what a lot of people anticipate, where the whole yen carry trade gets unwound. And, that's something we need to be aware of. My personal view is that the yen is going to rally back into the 130s. So an unraveling, but not a massively chaotic unraveling, but appreciation over there nevertheless. And of course, the flip side of that is that dovetails nicely, Pat, into our view that the US dollar is going to weaken, given that the Japanese yen makes up, it's quite a large constituent in the dollar index basket.
Okay, thank you for that. I thought we'd talk a little bit about, this week we saw the RBA minutes here in Australia, and it seems that they continue to remain cautious. Do you think this sets us up for a potential another rate increase coming here in Australia?
I don't think we can rule one out. I don't think we can rule it out. And the issue really is this very strong labour market. We've also had a weaker currency, and that's put upward pressure on import prices. And I think Michelle, DeBell, the new governor, has been quite adamant. There's no change really from predecessor Philip Lowe, and I don't think we can rule out another hike. I don't think they'll put it through till next year. They've got one more opportunity to convene before the end of the year, which is in December. Then they don't get back together again for another board meeting until February. I think any change to rate settings will be very unlikely to happen until then. And meanwhile, the RBA will be watching inflation like a hawk. They'll be watching, the wage market, any sign of a loosening in the labour, that very tight labour market. They'll be watching all of that pretty closely.
I saw some of the comments last night on the news about inflation here in Australia and how it's become quite domestic, with all types of services increasing, hairdressing, auto supplies, activities, everything going up. And they're now turning it to say it's more of a domestic inflation problem, which I think they're turning their attention to. Did you see any of that, Angus, last night?
Look, I didn't, but it is. Australia has got one of the highest inflation rates in the world. We've also got one of the lowest cash rate settings. So it's a valid topic really. And we know why the RBA have been cautious, because our monetary policy gets transmitted through to the economy pretty efficiently and pretty quickly, given the fact that most property owners have variable mortgage rates. So they're feeling it from day one when the RBA puts rates up. It's very different to what's going on in the United States, given that a lot of the mortgage owners over there were able to lock in for 30 years. So we've got these structural differences. So we're a lot more sensitive. I think the RBA have actually been quite sensible in their approach. Given monetary policy always has a lag effect, and they don't want to put the straw on the camel that breaks the proverbial camel's back and sends the economy into a recession if they can help it. So yeah, look, the bottom line is they've taken gradual steps. We can't rule out another rate hike in February next year. Unlikely that we'll see another one this side of Christmas. And it'll be interesting to see just how those inflationary pressures play out. Along with the along with the housing market and the labour market. My own view is that the government will do something soon on immigration, and they'll probably look to cap the number, given the inflationary pressures on housing, and probably also the impact on productivity. Productivity hasn't done much in this country for a while. In other words, all the incremental immigration that's coming in, we're not actually seeing GDP per capita expand. And this is something that Philip Lowe was really sort of harped on about before he vacated his position as head of the RBA.
And tomorrow we get the Black Friday sales. I think it'll be quite interesting to see what the spending and the retail numbers look like as we head into the Christmas season. How much people are actually spending in the lead up to Christmas. I know that all starts tonight, I think, when everybody goes out and starts trying to get their sales. How do you see that playing out? You think it'll be a big spending, good numbers, or might it be a bit flat?
Look, it wouldn't surprise me if it was a little bit flat. The economy is slowing down now in the US. It's slowing down rapidly. And when the economy was expanding at 5%, everyone was out there spending money, and I think that environment from sort of a quarter or so ago is beginning to change. We're seeing the lagged impact of higher interest rates, tighter financial conditions, and I think that is coming through now. We're seeing a lot of companies actually downgrade their earnings outlooks. So those higher interest rates are beginning to have an impact. But as you say, it will be interesting to see what happens in the US, and also just as it will be in Australia as we head into this busy Christmas retail spending period.
Question on uranium. At the conference, was there much talk about uranium prices and what was going on in that space?
Yeah, there was a little bit of talk about it, not much, which is always a good sign. It's always encouraging when not too many people are on board. One of the pushbacks was that deploying new modular nuclear reactors is easier said than done, and that because of the cost, not so much the uranium side of it, the uranium supply side of it, but the actual physical cost of building them. And so that was one of the pushbacks. But again, if we look at climate change and what's going on in India and China, who are building lots of these things, and if we look at the actual underlying spot price of uranium, which has been going up, I think the bull thesis for uranium and the uranium sector is very much intact, and there's still some way to go in this primary trend.
Okay, and if I just pivot a bit and we turn into wealth management, got a question here about cash levels. So what's your view on the cash levels now in the managed accounts we run? Obviously, we have a number of portfolios we manage on behalf of the clients. And I know you've been putting some of that money back into the market, but I think we're still holding quite a hefty or quite a solid cash position.
Yeah, look, we're still sort of carrying at least 10%. And whilst I think the US economy is headed for a slowdown, there's still probably room for a bit of volatility. We've had this big move to 4,600. I wouldn't rule out another sell-off occurring, in coming months, and in which case, I still think, having some cash is warranted. The earnings season in the US and indeed just about anywhere else has been quite patchy. Some companies have beaten their estimates, but any company that hasn't beaten estimates has been punished quite badly. And the global economy is slowing down. These rate hikes and tighter financial conditions are beginning to impact the economy, and of course that will feed into the stock market at some point. I'm still more nervous about the US given the high level of valuation, and that what we've really seen this year is the rally in the US has been all about multiple expansion and not about earnings growth. The market has been going up on multiple expansion. So there's an expectation that the growth will be there next year, and that the Fed will start cutting and any economic downturn will be quite shallow. So, as we were sort of talking about, towards the beginning of the webinar, Pat, I do think there's a place for cash at this point in time. And, we're quite comfortable carrying around 10% in our SMA portfolios and the funds that we manage.
Okay, it's always good. I like to ask you what you're looking forward to next week, or what you're looking at as any key things members may be able to focus in on, any announcements or key drivers. But we do know the next couple of days will be pretty quiet with the Thanksgiving long weekend and disruption to the U.S. markets. But as you look into next week, is there any key things you're looking at that might impact the markets over the coming week, excluding the next couple of days, obviously, because we think things will be a bit slow?
Look, we've got the Fed meeting coming up in December, but I don't think there's going to be any surprises there. I don't think they're going to raise rates before Christmas. Then, look, the only major thing really is to watch out for is if we get any earnings revisions coming through in December. The market won't like that. So if we start getting earnings downgrades, we got one from Deere and Company, big farming equipment manufacturer. We got one coming through from them last night. I think that's what the market's going to be on the lookout for. And the last thing that the S&P 500 needs now, with the index nearly at 4,600 and with the turning of the PE dial up to 18, 19 times, which is rich, is those downward revisions coming through for the next few quarters. So that's the one thing that I'll be looking out for. Apart from that, the reporting season's pretty much out of the way. We won't hear from the actual profit results from S&P 500 companies until late January, February, and it's going to be pretty quiet. We've got the economic data coming through. The non-farm payrolls number will be quite a big one. That'll come through in the first week of December, and of course then we get the inflation, the inflation numbers as well. So there'll be a bit of focus on those.
Okay, I think that'll wrap us up for the day. I'd like to thank all the members who joined us today. We will be doing a recording, so if you want a recording, we can get that out to you. Angus, thanks for your time today. I think we had a pretty good discussion, and welcome back from your trip in Singapore. And I'm going to go off and eat some turkey tonight and celebrate Thanksgiving as best I can.
I was going to ask you, Pat, what are you doing? You're an American. What are you doing for Thanksgiving?
I'm just going to probably go get a roast chicken somewhere and do it the easy way. I don't have the appetite to make the big turkey, but I will say it's probably my favorite holiday. Growing up as a kid, Thanksgiving was always the time you got to go home, spend time with friends and family, and be thankful for the things you had. It wasn't really too material like Christmas gets, where everybody's getting trees and gifts. It was more about, sitting around the table, telling stories, eating some good food, and spending time with family and friends. So I wish everybody's safe over there. They're traveling a lot.
I was going to ask you something. I always wondered because, with Christmas time, Americans typically just take Christmas Day off. They don't really take that extra day. They kind of do that at Thanksgiving, don't they? And would it be fair to say a lot of Americans actually roll it into a 4-day weekend and take the Friday off as well?
Yeah, I think they don't do Boxing Day over in over in the States like we do here. So you're right. It's typically things kind of shut down Wednesday, usually around 3 o'clock, 4 o'clock. People get on the road because Wednesday's the biggest travel day of the year. So, everybody's either in the car, the train, or trying to get to the airport and get to where they're ever going. And then Thursday's pretty much a write-off. And a lot of people, you're right, they roll the Friday into another day and have a pretty good long weekend. Although some things are still open on the Friday. Obviously the sales are on and the market's open a little bit, but yeah, it's probably the biggest and longest weekend we have. I mean, it's Easter's not even that long. I mean, they don't even do Easter Monday isn't an event in the United States. Good Friday really isn't either. It's a little bit of time off, but yeah, you're right. Thanksgiving's probably the longest and the biggest one, and that's where you see everybody traveling. So hope everybody goes safe over there. There's good traveling, and I think we'll sign off. And thanks again. And Angus, you and I'll be back in 2 weeks' time, and
Yeah,
we look forward to
absolutely.
speaking with everybody then. And have a good rest of the day. Thanks for now.
Thanks. Bye for now.